You walk into a grocery store with $100. Same store, same cart, same routine, but somehow you leave with less. Fewer items, smaller portions, cheaper brands. And it's not just groceries. Your rent went up, your insurance went up. Your car payment? Higher. Even your fast food order feels different. But your paycheck? Barely moved. And here's the part no one says out loud. This isn't just inflation. It's a system where prices are designed to move faster than your income. Think about the last time you got a raise, maybe 3%. If you're lucky, 5%. It felt like progress, like you were finally catching up. But in that same year, rent jumped 8%, groceries climbed 6%, credit card interest quietly pushed past 20%. So even when you win, you're still losing. And that gap? That's where the real story begins. Let's start with something simple. Why do prices rise at all? Most people are told it's supply and demand, or maybe inflation in a vague, abstract sense. Too much money, too few goods. But in the US economy, it's more specific than that. Prices rise because the system expects them to. And more importantly, it's built to reward it. Take businesses. Public companies don't just aim to make money. They aim to make more money than last quarter. Not the same, more. If they don't, their stock drops. Investors pull back. Executives get replaced. So what's the simplest way to grow profits? Raise prices. Not because costs always demand it, but because expectations do. Now layer in something else. Most major industries in the US aren't perfectly competitive. They're concentrated. A handful of companies control large portions of the market. Airlines, food brands, streaming, healthcare, housing. So when one raises prices, the others often follow. Not through some secret meeting in a dark room, just shared incentives. And then there's inflation itself. When people hear inflation, they think of something that happens to the economy. But inflation is also something that gets managed. The Federal Reserve doesn't try to eliminate inflation. It targets around 2% every year. That means, by design, your dollar is supposed to lose value, slowly, every year, forever. Now here's where it gets uncomfortable. If prices are expected to rise every year, then incomes need to rise too, right? In theory, yes. In reality, not evenly. Wages in the US don't move automatically with inflation. They're negotiated, delayed, sometimes frozen. Companies treat wages as a cost to control. But prices? Prices are a lever to pull, and that difference matters. Let's break the math. Imagine your rent goes from $1,500 to $1,650. That's a 10% increase. Your salary goes from $60,000 to $62,400. That's a 4% raise. On paper, you're making more. In reality, your biggest expense just grew more than twice as fast as your income. And that gap? It compounds, year after year. So where does that extra money go? Because it doesn't just disappear, it flows somewhere. Part of it goes to corporations. Higher prices with relatively stable costs mean higher margins. Higher margins mean higher profits. Higher profits mean rising stock prices. And who owns most of those stocks? Not the average American living paycheck to paycheck. Another part flows into assets. Real estate, stocks, private equity. When more money circulates in the system, especially through low interest rates, it often lands in asset markets first. That pushes asset prices up, which is great if you already own them. But if you don't, now you're trying to buy into a market that's moving away from you, faster than your income can keep up. There's also debt, because when your expenses outpace your income, you don't just cut back forever. At some point you borrow. Credit cards, auto loans, buy now, pay later. And here's the irony. As inflation rises, interest rates often rise too. So not only are things more expensive, the cost of falling behind gets more expensive as well. Now step back and look at the full picture. Prices rise steadily, wages rise unevenly, assets rise faster than both. Debt fills the gap, and the system keeps moving. But here's the narrative you usually hear. If you work hard, get a raise, and manage your money, you'll get ahead. And that's not entirely false, but it leaves something out. Because even disciplined people are operating inside a system where the baseline is shifting. Quietly, constantly. Your parents might have bought a home on one income. Today, two incomes sometimes aren't enough. Not because people are worse with money, but because the structure of prices, wages, and assets has changed. And the people who benefit most? They're not just working harder, they're positioned differently. They own assets that rise with inflation. They have access to cheaper credit. They earn income tied to performance, equity, or capital, not just hourly labor. So when prices rise faster than paychecks, it's not random. It's not just bad luck. It's the outcome of incentives, policies, and structures that have been building for decades. And once you see it, you start noticing it everywhere. The smaller cereal box at the same price, the premium version of things that used to be standard, the way every service quietly becomes a subscription. It's not just that things cost more, it's that the system is constantly adjusting what your money can do. So here's the question that lingers. If your paycheck keeps chasing prices, and prices keep moving ahead, at what point does getting ahead stop being about effort and start being about where you stand in the system to begin with?